My name is Peter Mauthe. I'm with Trademark Capital Management, and I have a chart I want to discuss with you today, which I think has meaning not only for our understanding of what the Fed is doing, but a historical perspective that also bears on investments and investment methodologies. So let's take a look at this graph, which is a weekly graph of the federal funds effective rate. Now, the effective rate just simply means the open market rate that the Federal Reserve has control over. What's important about that is that all other interest rates for loans and the economy are based on this federal funds effective rate. This chart is a weekly chart going back to 1970. So we have over 50 years of history that we can see here. Now, a couple things to note are that from about 1985 or 86 to the left were during periods of high inflation. From the early 90s to the left were periods of time where interest rates were generally above 5%. Now, this is really important because it takes a lot of economic forces, inflation among them, to get interest rates to go above 5%. Once they get there, those economic forces tend to keep interest rates high for a prolonged period of time. The other side of that is that once interest rates come below 5% in a meaningful way, that also takes a great deal of economic confluence of events. It means that inflation has to be relatively low. It means that money supply has to be relatively abundant, and a number of other factors. And when interest rates are below this 5% level, they tend to stay there for a long time. And you can see to the left that each time interest rates came down to this 5% area, which is highlighted in the yellow zone, that tended to be a floor up until the early 1990s. Once interest rates fell below that 5% level, then 5% zone became a ceiling, which is what it's been for the last 30 years. Well, if your eyes take you all the way over to the right-hand side of this graph, you'll see where we are today. We're right back up to 5%. And of course, the question is are we going to stop here or not? Now, a couple things as to how this translates into not only the economy, but our investments as a whole are this. If interest rates follow the pattern that they've been in for the last 30 years, interest rates at or about 5% tend to achieve the Fed's objective of slowing the economy and easing inflationary pressures. If this is going to be one of those times like we've seen in the last 30 years, then we can expect interest rates to begin to top out in this 5% area, which means we're pretty much done with the interest rate hiking cycle. But just like back here in 2008 and 9 or 2009-ish, we started to see interest rates were hiked as we got into actually 2007. Then we stayed here for a prolonged period of time, and then this was the financial crisis into 2008 into 2009. Look, the most important thing for our economy from an investment standpoint is, look, this period of time back here was the beginning of the bull market that went from 1982 to 2000. You can see a good part of this period of time, interest rates were way above 5%. So it's not necessarily the level of interest rates that is bad for investors. It's the direction of interest rates. So here we are again. We've been through a challenging 2022 and into 2023. because interest rates were going up. The fact that they're back to 5% isn't as important as the fact that they're going up. So the thing for us to watch in coming months is whether the Fed does end up stopping their rising cycle of interest rates as we get into the summer, and thereby give the economy a chance to catch up. Well, we'll all have to watch this in coming months, and we'll be back with another view of this later in the year. In the meantime, I'm Peter Mauthe with Trademark Capital Management. Thanks for joining me today.